Appian delivered Q2 results this week and they were a little bit meh, right? ARR growth of 17%. That meant net new ARR of 79 million in the last 12 months. They spent 227 million on sales and marketing to generate that growth. That gave them CAC payback of 40 months over the last 12 months. Now, bear in mind, right, that 40-month figure doesn't sound terrible, right? If you think about some of the others, right? So in Q1, we had Workday with a 93-month CAC payback. ZoomInfo reported kind of 99-month CAC payback in Q2. But what we need to keep in mind is that Appian's only at 500 million in ARR. And so they'd obviously want to be growing much faster and much more efficiently at that run rate. As we've talked about before, right, the best companies really fly through that mark, right? HubSpot was growing at 35% when they were at 500 million. CrowdStrike was growing at 100%, Monday was growing at 60%, right? So the best companies really fly through those hundreds of millions on their way to $1 billion in ARR. But despite the growth issues, they did make some big strides on operational efficiency year over year. So operating margin improved to -6% from -27% a year ago. Free cash flow doubled to 26% from 13% a year ago. But one other area of concern is net revenue retention. So that was down to 111%, still strong, but not as healthy as the 118% that they reported a year ago. And when we look at this chart, we can see that that's the 5th quarter in a row that they've recorded a drop in net revenue retention rate. So that peaked at 120% in Q1 of 24 and has been declining ever since that point, down to 111 that we get this quarter. They did beat revenue estimates for the quarter, so they got a nice little pop to the share price of about 6% post earnings. They've got a market cap of about 2.1 billion or about 4 times Q2 ARR.